Welcome back.
Thank you, Scott.
What do you think? We just got a little, ahead of ourselves, or I don't know. Maybe we just need a breather because it's been remarkable.
Yeah, that's right. I wouldn't be surprised if there's some profit taking today. I don't think it changes the case that stocks are probably going to do very well between today and the end of the year, and we get a pretty important report on Friday, which is PCE deflator.
Yeah. You surprised that this market has continued to just ramp higher, almost unabated?
I think there was a sequence of events that justify the move, because we know last week we got a Fed that has made a dovish move, ending its inflation war or shifting it towards managing the business cycle. We know that 65% of fund managers are underperforming their benchmark, and we know $240 billion was pulled out of equity. So between now and year end, which is a small window, you do have fund managers trying to catch up, and I think a lot of investors reorienting their portfolio towards a nicer Fed, a less hawkish Fed. And I think stocks are up. Investors need to allocate to stocks.
Unless investors need to take a breather themselves. I had a conversation yesterday with Eric Johnston of Cantor, who's been as bearish as you've been bullish, and told me he just can't show up now and all of a sudden change. Here's why.
I would not be able to come here and say high conviction bullish based on the current multiples, where we are in the cycle, where earnings are, where positioning are. It's just not even close. Okay, well, what I would need is to see either a recession or close to a recession where people think that it's coming. We get a big growth scare, and the unemployment rate starts to go above 4%, a little bit of a cleansing, and lower prices.
In other words, you're going to get all bulled up, even more so now with multiples expanding to where they have?
Well, as you know, valuation isn't really why anyone should ever sell a stock, nor why they should buy a stock. It really should be whether earnings momentum is accelerating. And next year, it looks like capital spending is going to pick up. There's a lot of surveys showing this, and there's a gap between the hard and soft data. So there's a CapEx cycle. We also know mortgage rates could drop to something like a 4.75, 5.2 next year.
Well, that's not ahead of ourselves a little bit?
That would be taking a normal spread to the current 10-year. And that 200 basis point drop in mortgage rates, we know, would stimulate the consumer and reliquify regional bank balance sheets, which is an earnings story too. So I'd say earnings momentum picks up next year. We have a Fed that's trying to at least maintain the business cycle, and investors are bearish. There's a lot of anchored views. We just heard one clearly articulate that they're going to only turn bullish if there's a recession.
Yeah, but I feel like the bears are kind of dropping like flies now, right? There aren't that many of them. I've seen some strategists who were very bearish over the course of the last year suggest, stocks can continue to go up. This Fed pivot is that powerful. The other side of that, though, is what Eric Johnston and others would suggest, that it's a little too early to think that earnings are going to live up to all of this hype. A lot of hype that you have. Your earnings number last time you came here, the best case
for 2025,
amazing case, unbelievably incredible case was like $280.
But
do I remember that correctly?
Yeah, you are, Scott, but that's not a prodigious feat. It's about a 10% CAGR. So it's like saying 5% from buybacks, nominal GDP, and weaker dollar get you there. I don't think it's a lot to ask to get to 280 in earnings. But I think most importantly, the market internals don't speak to what happens at a top. This is really early cycle behavior, a huge expansion of market breadth. Stocks really peak when you get good news and they go down. We haven't had good news. Today's sell-off isn't off some great headlines. It's just year-end rally.
Do you think the market is at all ahead of itself in the idea that there's going to be as many cuts as one would like to think based on what happened, at the Fed meeting?
I think the Fed is trying to figure out how to communicate future cuts. And the market's going to get anxious about it in the first half of next year. That makes a lot of sense to me, because we're going from a data-dependent fighting inflation now to under what conditions does real rate get defined, and when should we titrate that and cut rates? I think that's a debate in the first half. That's kind of why our 2024 view is most of the gains happen in the second half.
Do you think we're pulling forward gains at this point?
Yeah. I think December is going to end up very strong. And I think the last time I was here, I thought it could be parabolic, which it does seem like it's going parabolic. But a move like that isn't consolidated sideways, right? Maybe there'll be some payback in March or April.
I just want you to hold your thought for just a moment. I want to bring in John Spallanzani of the Miller Family Office, who is a portfolio manager there. He watches the market like a hawk. What do you make of what's happened here within the last 30 minutes or so, of what you think is a culprit of this sudden sell-off? If there is one, anything more than just saying, hey, we've reached some pretty lofty levels, let's just take some chips off the table for a minute and catch our breath.
Hey, how you doing, Scott? Hey, Tom, how are you? Hope all is well. Yeah, so it just seems like there was some big prints in the zero-date options, which is not a surprise. It's an expiration today. There's about a 500,000, almost 1 million calls and puts that printed a little while ago, right before the sell-off at the 475 strike. So that was also the VWAP level, which is for those technical people, the weighted average price that guys are pegging for some orders. And then once we took out 475, it seems like the selling just begot selling and, knocked us down 50 handles here. So, we had a stair-step rally with nothing really hitting on the VWAP all the way from really kind of, probably the 5th or 6th of December. So once we broke the VWAP, technical guys got to sell, and the zero-day guys just kind of piled in.
I think it's just like maybe a little bit of an air pocket for a moment there. Yeah,
it seems so. Volume obviously is lighter as we get closer to Christmas, people taking off, and it was definitely an air pocket because we went down 50 handles pretty easily from 475 to 469. But some people said that there was a couple of stories out there that might have done a couple of tweets that might have been put out there with some China, some other stuff, but I don't think it was that. I think it was more the technicals and the zero-date options, which everybody's been talking about for a long time, where you have huge gamma levels. I mean, you could imagine what 1 million options that are expiring today, how much the hedge is if you got that trade wrong. So that's kind of
right.
Yeah.
That's like the latest and greatest trend as we're learning, I think, more and more every day in options trading, whether it's from the most experienced people who are out there to more novice investors who are trying their hand at options trading as well. I'm going to let you run. I think you're with me tomorrow anyway, so we'll catch up about the rally, where we think 24 is going to go. John, thanks for calling in. I just wanted to get some insight. Yep, just wanted to get some insight on just tick by tick here as we head over the final stretch. At this point, the market's come so far so fast. I mean, bar's high. I mean, there's a lot now to live up to. You got to have the cuts when we think we're going to have the cuts. You got to have earnings live up to what now expectations are going to rise to. You got to have the economy hang in there to justify the multiple. You got to have rates come down to help justify the multiple. Is it too much at some point?
Well, you're describing a great wall of worry, and as you know, markets climb a wall of worry.
I know, but it's like maybe a wall of reality too.
Well, I'd say that at the start of this year, a lot of the bear arguments you played for me earlier were exactly what people said it on January 2023. We're going to have a hard landing. You can't buy stocks until employment goes up. Earnings are going to be disappointing. And the year played out, earnings were good, and we didn't have a hard landing. Look at labor supply. It's growing now, so I don't know if unemployment has to go up. And inflationary pressures are decreasing. Look at UMich, the Consumer Confidence Survey today. They're back to October 2020 levels. I mean, inflation is disappearing from consumer expectations. So I'd say that there's the thing that the bears might get wrong is multiples will do a lot more increasing than people expect next year.
All right, let's bring in Christina Hooper, sitting here as well from Invesco. This sudden move aside, what is your view as we sort of race towards the end of the year here with these extraordinary gains since November started?
Well, I think the key is that monetary policy, really since the Great Recession, has had an outsized impact on markets. It's really been such a critical driver of markets. And a perfect example of this is what we've seen this year, and especially what the Fed has communicated. If we look at the September dot plot, that implied 50 basis point cut after an implied 100 basis point cut in June was the start of a big rise in yields. And now, of course, we're getting the Fed communicating finally that we have actually seen the end of the tightening cycle in July. And that has had an outsized impact on markets, as it should, because monetary policy has been so important.
So you say it's so justified. I mean, we to your point, is we have, as an investor class, become conditioned to the don't fight the Fed, because we've learned how powerful it could be after '08. And anytime there was any, crisis of magnitude, the Feds had our back. And the time they didn't, we had a terrible year last year because they were raising rates rather than cutting them. Now the paradigm has once again changed in our favor. That's the argument you're making. So this is all justified, the way the market's reacting.
Absolutely. And the economy is cooperating, right? We have an economy that has been quite resilient, and we also have disinflation very much underway. People were very skeptical earlier this year, and I think finally in the last few months there's a realization that the disinflationary process is happening. It's very significant, and we will ultimately get close to that 2% inflation target within a reasonable period of time.
Yeah. What about the broadening? The Russell, I spoke too soon, of course, when I said it was hanging on still a positive, because now it's rolled over with everything else. It's down about 0.5%, but it's been a remarkable run. The Russell, even with today's pullback, is up more than 11% over a 1 month period of time.
Oh, absolutely. And I anticipate a continued broadening of the market. And I think small caps are going to play a critical role, as are cyclicals, because what they're doing and what the market typically does is it's discounting an economic reacceleration in the back half of 24. So it makes sense that the more cyclically sensitive parts of the market are performing better.
This is your playbook.
Yes, that's right. And then, when it comes to valuations, I mean, S&P 600's, 11 times next year's earnings. I mean, you could see a lot of multiple expansion there. That's why I think small caps could rally 50%, next year.
Yeah,
something huge.
You continue to make that case. At the expense of what? At the expense of what? Well, most people would say at the expense of maybe mega cap.
Yes, I think that's probably correct. That mega cap, actually, someone pointed out, and I think I actually checked it was correct. FANG's actually cheaper than it was at the end today than it was at the end of 2021, because earnings have gone up like 30% and the price level is only up 2%. But next year, the multiple can be harder to expand for the FANG, so it's just more EPS growth. Whereas things like financials and small caps can see 50% increase in multiples plus earnings growth. So I think you're right. I think that if you're talking about PE expansion, it's more the small cap names.
Yeah. How do you see that?
Well, I think it's at the expense of cash. It's at the expense of a lot of different asset classes. But where Tom and I differ is that I don't know what is going to happen in the back half of this year. In fact, I suspect what we're likely to see is a leadership shift and more of a focus on defensives and quality, because markets will be discounting 25. And maybe that's...
Not to mention a presidential election where who knows what's going to happen, how messy it might get. Just don't know.
Right. And let's also not forget the long and variable lag of monetary policy. So if we use that rule of thumb that it's 12 to 18 months between monetary policy implementation and when we see it show up in the economy, well, that could mean it really hits in 24. We really don't feel the cumulative effects until the end of 24. So could we potentially see that recession in 25, which markets could potentially start to discount in the middle of 24? I don't know that yet. We just don't have enough visibility.
What if, I saw a headline, I think, earlier today from the Fed's Harker saying that, the economy's slowing faster than the data is suggesting. What, in fact, if that is the case?
Well, I think, one, that sets up for a growth scare in the first half. And it sets up for the market to really be debating with the Fed about what they should be doing. I would say that makes sense. That's why I think the first half isn't where you make your money next year. But does the Fed have the tools in place? I mean, Fed funds is at 5.5%. They could do a lot of cutting, and they have a lot of tools to really stave this off. So
yeah, but part of I would like to believe that part of the bull case is, yes, the Fed's going to cut. It's going to cut because it can. It's not going to cut because it has to. You're painting a scenario in which it doesn't matter. They have the tools. If the economy slows worse, if it looks like we might go into a recession, well, they're going to cut, so that's positive anyway. Is it really, though, if they cut for that reason?
It is, because it's one thing to be slowing if the consumer and corporates were over-levered. They're not over-levered today, but they're paying a lot of money to borrow money. So it's a cost of money issue that's slowing the economy. So if the Fed cuts rates, you're actually alleviating the biggest pressure valve on growth. So
yeah, but how do we justify multiples if the Fed cuts rates because the economy's gotten that bad?
Well, it's actually, that's one perspective, but the reality is they're cutting rates because real rates are too high. That's really what's, it's not appropriate to be at 5.5% if inflation's running at 2%, because you're running a real rate scheme that causes a recession. And I think, in fact, if we're slowing, it's proof that the real rates are actually too high right now relative to inflation, right? Inflation's tracking at 2%. So I think that there's going to be a bear argument, but to me, it's actually perfectly in alignment with the idea that inflation's falling, real rates are too high, the Fed actually has to make cuts. But that's a debate in the first half.
The idea that there's no way this market is pricing in a recession. No way. I mean, we've already placed our chips all in the middle of the table that we're going to have a soft landing. We're placing our bets that the Fed's going to cut because they can, not because they have to. If they have to, does that change the whole paradigm about the market?
I think the question is moot because they don't have to this year. I think they're
in 24, you mean? This year, you
yes,
say
exactly.
24.
I think they start to cut in the second quarter because they should, because they admit they are in restrictive, very restrictive territory right now. And so the reason for cutting is the right reason. Again, I think that what is undecided at this point, undetermined at this point, is what happens in 2025. But I anticipate something of a bumpy, brief landing in 24, a mid-cycle reacceleration, and then we could see more problems in 25. But it remains to be seen at this point.
What about, Christina, fixed income? Where are people supposed to be right now?
Well, if you anticipate a bumpy landing, as I do, I think investment-grade credit looks really attractive. Also, emerging market debt. It's a supportive environment in emerging markets. We're seeing a dollar that's weakening. I think that's going to continue. So those are two areas that are attractive. In terms of duration, long.
You have a view of that real quick before I go?
I think all that makes sense. I think bonds are going to do pretty well, but of course, if bonds do well, PE goes up. Right.
See, that's why you have a big smile on your face as you finish that statement. Thank you, guys, very much. Happy holidays to you both. We'll see you on the other side, I'm sure of that. Christina and Tom. All right, let's send it over to another Christina.